Bismillahirrahmanirrahim. This is the second video on profitability analysis. And in this video, we will explain how to evaluate firm's profitability using return on assets. We will explain how to calculate return on assets, and we will also talk about disaggregating return on assets. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with discussing how to calculate return on assets. Return on assets evaluates the efficiency with which a company generates earnings from its assets. It helps investors and analysts assess the operational efficiency and profitability of a company independent of its capital structure. It is calculated as net income plus 1 minus tax rate times interest expense plus non-controlling interest in earnings divided by average total assets. Return on assets evaluates a company's profitability by focusing on net income before accounting for financing cost like interest expenses. Interest expenses are added back to net income in on assets calculations because they are deducted when calculating taxable income. The tax benefits from interest expenses depends on the statutory tax rate of the country where the debt is issued. For instance, the federal statutory tax rate in the United States is 35%. The total tax rate affecting net income includes state, local, and foreign taxes, along with adjustments for differences between accounting and taxable income. Average total assets are typically used in the denominator of return on assets to smooth out fluctuations over the period analyzed, providing a more consistent measure of how effectively assets are being utilized. So let us calculate return on asset for Starbucks for the year 2015. We have the company's consolidated statement of earnings and we have the consolidated balance sheet, and we will use the same formula to calculate return on assets. Now the net income is how much? Net income is 2,757 2,757.4 plus 1 minus tax rate. Let us say that is 35%, so that is 0.35 times interest expense, and interest expense is 70.5 plus non-controlling interest, and that is 1.9 divided by the average total assets. So the total assets for 2015 is 12,446.1 plus 10,752.9 divided by 2. So this will be equal to 24.2%. Next, let us talk about adjustments for non-recurring or special items. Now, non-recurring or are non-recurring are one-time items, and they include gains from acquisitions, losses on debt, or other non-recurring gains or losses that can distort net income. Analysts often exclude these non-recurring items from the return on assets numerator to focus on core operational performance. By adjusting for non-recurring items, analysts aim to gauge the company's sustainable profitability. Adjusting for tax effects related to these items, if disclosed separately, enhances the accuracy of the return on assets analysis. It scrutinizes and adjusts the non recurring items, helps in understanding the company's consistent financial performance and trends. It enables meaningful comparisons of the company's return on asset with its peers and historical performance. Next, let us talk about disaggregating return on assets. Now, return on assets is equal to profit margin for return on assets times assets turnover, and profit margin reflects how effectively a company turns sales into profits. Assets turnover reflects how efficiently a company uses its assets to generate sales. The product of these two, profit margin times assets turnover, gives us the return on assets, which indicates the overall effectiveness of the company in generating profits from its assets. Return on assets is a composite measure that considers both how well a company converts sales into profits, that is, profit margins, and how efficiently it utilizes its assets to generate sales, that is, assets turnover. So, this makes it a valuable metric for assessing the profitability and efficiency of a company's asset utilization. Let us solve an exercise on how to calculate return on assets. Now, Nucor, a steel manufacturer, reported net income for 1,831 million on sales of 23,663 millions. Interest expenses are 135 million and non-controlling interest is 314 million for 2008. The income tax rate is 35. Total assets are 9826 at the beginning of the year and 13874 at the end of the year. Compute the rate of return on assets for the year 2008 and disaggregate return on asset into profit margins for return on asset and assets turnover components. So we will use the same formula that is stated over here. Now the net income is 1831. So we have net income of 1831 plus 1 minus tax rate, and the tax rate is 35%, 0.35, times the interest expense, and the interest expense is 135 million. And we are going to add to this non-controlling interest in earnings, and the non-controlling interest in earnings are 314. This will be divided by the average total assets, and the assets at the beginning are 9826 and at the end it is 13874. So 13874 plus 9826, and this will be divided by 2 to determine the average. So this is the left hand side of the asset of the equation, and if we calculate, this will be equal to, so the return on assets will be 18.8%. Now this is equal to, we simply have the same value, the whole value, this whole is to be put back again for net income in times interest, plus, sorry, this should be plus net income plus interest expense net of taxes, and we have the non-controlling interest as well as of net income plus interest expense net of taxes, uh, plus non-controlling interest divided by sales, and the sales for the company was 23,663. So we have 23,663 times assets turnover, and we have the same value for the sales, 23,663 divided by average total assets, and that is the same, 13874 plus 9826 divided by 2. So this is for the profit margin for return on assets. When you substitute when you calculate, it will be 9.4%, and times assets turnover, and assets turnover is 2 times 2. So you can see that the return on assets is equal to profit margin for return on assets times assets turnover. So this completes the the second video on evaluating firms' profitability using earning per share analysis. Using return on assets. And I hope you have enjoyed this presentation. And if you found value in this video, then please like, subscribe, and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah, I will reply you back. Thank you so much and happy learning.